Dear students, very good morning all. Once more all are welcome to Auditing and Corporate Governance new classroom. Today we are going to discuss general principles for valuation. The basis or mode of valuation of different types of assets differs depending upon the nature of the concern and the purpose for which the assets are held. For the purpose of valuation, assets may be classified into the following types: fixed assets, current assets, intangible assets, wasting assets, and fictitious assets. Then fixed assets. They are acquired for permanent use in the business. It is not for resale in the ordinary course of business, but for the purpose of enabling the profit to earn profit. Enabling the business to earn profit. These assets will be used for a pretty long period. For example, land, building, plant and machinery, furniture, motor vehicles, etc. These fixed assets, except land, are subject to depreciation. They are valued at a cost less than a reasonable depreciation according to its nature. The provision for depreciation on fixed assets is necessary from legal as well as economic standpoint. They are valued at what is popularly known as going concern value or token value or conventional value. Second point, current assets or circulating or floating assets. Current assets are those assets which are acquired for resale or produced for the purpose of sale or converting them into cash. The business is carried on these assets. They are purchased for a short period to be resold at the best market price to earn profit. Examples: stock, semi-finished goods, book debts, bills receivable, cash and bank balance, etc. These assets are called short-term assets. As regards to cash and bank balance, that is liquid assets, no valuation is required. It is the amount same as shown in the cash book. Book debts and bills receivable are normally valued at a book value, but provisions for bad and doubtful debts are to be proceeded for book debts. The raw materials are valued first in first out, last in first out method or average cost method. Semi-finished goods are valued at cost. The closing stock of goods is valued at the date of balance sheet at a cost price or market price, whichever is lower. The basis for this principle of valuing these floating assets or current assets is that anticipated profit must not be accounted for, while that all anticipated losses must always be taken into consideration. Third one, intangible assets. Intangible assets are those assets which cannot be seen or touched. They are not visible in the concrete form. They are useful for business like any other assets. Examples are goodwill, copyrights, patent, and trademark. These assets are shown at the cost price. Intangible assets are treated as fixed asset for the purpose of valuation. Fourth one, wasting assets. Wasting assets are fixed in nature, which are depleted gradually or exhausted in the process of earning income. The value of these assets diminishes gradually on account of exploitation or extraction or depletion. Examples are mines, quarries, oil wells, etc. Waiting exhausted by working, and the process involves depletion of capital employed. Therefore, a charge should be essential to maintain capital employed so as to give a true and fair value of assets. Fifth one, fictitious assets or deferred revenue expenditure. Fictitious assets are huge revenue expenditure that has been temporarily capitalized with the object of spreading the amount to a number of years. Examples are special advertising cost, preliminary expenses, development expenses, debenture discount, discount on issue of shares. These are terms of expenditure which have no exchange value. Every year, a portion of these expenditure are written off in the profit and loss account. Balance account of these assets are shown in the balance sheet. Next part, valuation of liabilities. Then how can we classify the liabilities? Liabilities are classified into three groups, that is current liabilities, fixed liability and contingent liabilities. The actual amount of liability can be easily determined. So the auditor should be careful in regards to the ascertainment of liabilities. He should see that all liabilities shown in the balance sheet at its correct value, and such values are original values, and it should not be overstated or understated or deliberately omitted. Then in the case of current liabilities are those liability of the business which are short-term liabilities. They are to be settled within a period of 1 year. Examples are trade creditors, bills payable, short-term deposit accepted, outstanding expenses, unexpaid income, etc. Second part, fixed liabilities. Fixed liabilities are those liability of long-term nature. This type of liability will be made as per agreement and settled on long-term basis. Principal amount with interest will be paid on the due date. Examples are long-term loans borrowed, long-term deposit accepted, etc. Then contingent liabilities. Contingent liabilities which are not actual liability but which may become an actual liability on the happening or non happening of an event in future. Examples are guarantee given, claim of employees pending settlement, compensation pending, liability of bills discounted and not matured.